Okay, now we'll look at the option the same way futures market, whatever is the way the futures market is working. Similarly, we have options market again on the exchange itself. Now I'll download one options data. Again, probably we'll look at the Infosys itself. Right, I'll download the options data for Infosys again from the NSE website. In the products, I'll go to equity derivatives, historical data, and contract wise archives, where this time I'll select stock options, not stock futures. I'll take an option on the stock and any company, again Infosys itself again. Yeah, the year I'll take again this recently closing 2012, the expiry being the June 1 itself. In nseindia.com website. Okay, you go into the products section, products and equity derivatives. Okay, so here I am selecting the option stock of Infosys 2012. The expiry date, again options and futures, both of them will expire on the last Thursday of the month. OPT STK. Okay, this is option stock, option index. So if the option is directly on NSE, Nifty or Sensex, we are calling them as the index option. If it is on some single stock, because Infosys and all are like stock, so I am taking the option stock. Then I will get all the companies' names, all the stocks on which options are available in the market. So I'll just choose Infosys there. Any company you can choose. Practice, you can always change the name of the company and you'll do a different practice there. And year, the next expiring one is what I'm taking. So the year wise, I'll take 2012 and the June, next 1 week expiring option. And option type, I need to choose whether it is a call option or a put option. So as we have discussed, call is something taken by the buyer of the security. Put is taken by the seller of the security. Someone who wants to sell Infosys and wants to protect himself to back out, he will take a put option. Someone who wants to buy Infosys and wants to protect himself, he will take a call option. Just probably to understand the options slightly more better, this grid, getting a clarity on this grid itself is much more simpler task. So let's say there is a call option and a put option. So there could be a buyer of the call option and there could be a seller of the call option or put option. So in this grid, let's say when I say buyer of a call option, so he will pay the premium today, and by paying the premium, he will get the right. What is this right? To back out if he does not want. To expire in the middle itself. He does not wait until the expiration. If he wants, he can back out of the contract. That is what is a typical call option. When a buyer is buying it, he is paying a premium. Similarly, for a seller of a call option, he will receive the premium from the buyer. He will receive the premium and cannot back out. He has to oblige. Like probably the simpler example for this is, let's say I want to take a house on rent, right? I look out for a house and I pay some advance to the owner. By paying the advance, the person who has taken the advance, he cannot back out in giving the house to me. Whereas I can very well back out. If I don't want the house, I'll choose some other new house and go there. But probably the owner will not refund me that advance which I have paid. So in any case, wherever I am paying some kind of a premium, with that I am buying a right or an option to back out if things are not going in my way. That is what typically I am saying in case of option, because option wise there is an option for me either to go forward or to make it expire. Similarly, someone who has bought a put option, he will also pay a premium, but by paying this premium he will get right to sell the security in future. This guy will receive the premium, but cannot back out. So in short, just like a security, even the derivative or option also will have a buyer as well as a seller. The buyer of the option, whether it is call or put, the buyer of the option will pay the premium to the seller of the option. And by paying the premium, he will get the right. That right could be either for buying the security in a future date, which is in the case of a call option, or selling the security at a future date, which is in case of a put option. So anything, the buyer of the option, whether it is call or put, he will have to pay a premium to the seller. Now, with that perspective, let's say if I look at the full-fledged data, instead of taking historical, I'll take the live data, at least the last traded scenario, then the historical data I'll get into. The last scenario, if I want to get, I'll go into the live markets and I'll choose the equity derivatives here, where instead of Nifty here, I will choose the name of a company, Infosys. I'll choose the name of a company here, Infosys. It will give me all the options that are available on the Infosys security. I click on Infi. These are what are all the contracts that are available on Infosys security. Now first let's understand this so that we can do appropriate calculations on this. What I'll do is I'll copy this into our Excel sheet. Yeah, this is live means now it is not open until yesterday. Under the live market, equity derivatives, equity derivatives. Yeah, there you just type in Infosys. In Nifty you don't require. Infosys you just put. You just leave it as it is. There you just type Infosys, you will get the price. I just copied that entire stuff and I am pasting it. Yeah, the total stuff. Yeah, copy and paste. I copied this entire table. Copy this, and this is not exportable to Excel. So that's where I copied the entire table and pasted it into the Excel sheet. Yeah. I mean, you can, if you want, you can paste it as a picture also, but by default, it will paste the table as a table. Yeah. Now let's look at this data. Here there is a mention about a call option as well as a put option. In the live market, there is a mention about call option as well as a put option. Now the same scenario exists. There is an open interest, the change in the open interest, all that stuff, the number of contracts, volume is nothing but the number of contracts, and the last traded price, the net change, what is the quantity bidded and the price at which it is bidded. So there is a bid and an ask, because there could be from a seller perspective as well as from a buyer perspective. There could be a seller of the call option as well as just like this grid. There could be a buyer of the call option and seller of a call option and vice versa. So that's where you are seeing bid as well as ask. Similarly, for the puts also the same situation. Now if I see here, what are we meaning from this? The strike price is the most important aspect in the options, where the buying or selling of this Infosys in future, the future is nothing but 28th June, happens at these prices, right? So it could be anywhere from 1800 per share to 3450 per share. I may want to buy Infosys at 1800 per share or 3000 or 1900, 1950, whatever it is. Now what it says is, if at all I am looking at, let's say 2500 per share, I am looking at 2500 to buy Infosys at 2500 per share on that date, 28th June. Today I have to pay a premium of 14 rupees 90 paisa for every share. The last traded price for the call, here the call LTP, last traded price, is nothing but the premium. Premium is one time outright payment. So I have to pay 14.9. When I pay 14.9 today, I have the right to buy Infosys at 2500 on that date. That is what we have in the next. I mean, we'll use couple of models. The contract size is within the, you see here, the lot size 125. The open interest 125. You see here, it's a multiple of 125 itself. Yeah. Lot of 125 need to be purchased or sold. Even here you see here the quantity they are saying. This is the bidding quantity. So there are some lots of, there are some at 500, some at 250, some at 1000, multiples of 125 probably. Some multiples of 125. The minimum is looking at 125. Per share, not the contract. It's a per share price. So per share you have to pay 14.9, which is non-refundable. So by paying that 14.9, you are purchasing a right. That right is to back out. In case you don't want to buy Infosys at a future date at 2500, you can very well back out. So you will lose at the max. Your loss is 14.9. You will not lose anything more than that. Probably if Infosys share price is going up and up and up by that date, you will buy Infosys at 2.5. The difference between those two is also adding up to your profit. So let me put it as simple. I'll take one example. Today, the share price by the end of this period, which is up to yesterday end, the Infosys share price is 2475 in the market. Right? Now, I'll take this example. The share price is 2475 in the market. Now, I'll take an option to purchase Infosys at 2500 on 28th June. For that, today I have to pay a premium of 14.9. By paying 14.9, whatever may be the scenario on 28th June, I can buy Infosys at 2.5. If I want, I will buy. Otherwise, I will not buy. Now, if I buy, when will I buy? Only when I see that I am at a benefit. That benefit is if the stock price, if the live price on 28th, let's say is 2520, then I prefer buying it at 2500. Otherwise, I can very well buy it at, let's say on that day, the market price is 2480. I can back out of the contract because I have paid some token advance. I can very well back out of the contract and I can buy it in the market itself at 2480. So that is what is the difference between option and other derivative contracts. Here backing out is pretty much legal because you are paying some advance in the beginning itself. So if the price goes to 2480, I will back out and buy it in the market itself. But if it goes to 2520, I will exercise the contract and buy it at 2500 itself. Now because of this, here I am getting a profit of 20 rupees. Here there is a loss of 14.9 rupees. So overall I am still getting a profit of 5.1 rupees. In this entire transaction, I am getting a profit of 5.1 rupees. So by buying an option, by getting into an option, I am primarily looking at again a locking of the price. But at the same time, if the price goes down in the market, I am trying to protect my base so that I don't lose heavily. Whereas in case of other contracts, there is always a chance that either my gain can be very high or loss can be very high. Whereas in case of option, I cannot lose beyond a certain number. In whatever may be the case, I cannot lose beyond a certain number at all. That is what is the benefit that I get going with the option. Now, just trying out the same on this data. If at all, I would like to purchase Infosys at 2400 only, the premium will be very high. 77 rupees is what I have to pay as a premium. Whereas if at all I want to purchase Infosys at 2450, I have to pay a premium of 39 rupees into 125 shares. That is the premium which I have to pay, and that is non-refundable. Only when I think I can get something more than that. When will I get something more than that? If the market price of Infosys on that day is at least more than the price which I have contracted it by that much amount. Let's say I want to buy Infosys at 2450. So for that today itself I am paying 39. So what is the overall amount I am paying? 39 today plus 2450 on that day. So totally I am ending up paying 2489. So I will have a benefit only if the share price of Infosys on that day goes above 2489 only, not 2450. Only after it crosses 2489, then only I am at a benefit. And probably this 7 days, there is some interest factor also. Right? The 2489 is assuming zero interest for the 7 days. But if I put in a little bit of interest factor for these 7 days, right, time value of money factor for these 7 days, probably that may still go to 2490 or 2491 also. So only if the Infosys price, if I assume that the Infosys price will cross 2490 or 91 on that day, then only I would prefer going with this kind of a combination. Otherwise, similarly, here also, okay, in this combination, 77.6 is what I am paying out, right? And on that day, I'll have to pay 2,400. So, totally 2,477.6, slightly lesser than the earlier case. 2489 or 2490 was our case. But here 2477 or 78 only. But what is the problem here? If I lose, I'll lose 77.6 into that much number. Whereas in the earlier case, if I'll lose only 39 into that much number. So my loss is slightly lesser. So I have to evaluate all these things before I come down to a number. So what is the better price? Right? How much should I pay as a premium? What is a better premium for this kind of a security? There are a couple of models. One, a direct formula based model, which is called as a Black-Scholes model, and one, a typical tree kind of a model. We'll see both of those. We'll put them in Excel sheet. But they will clearly tell us what is an appropriate price. Because this is not about an appropriate price. This is market price. There is a difference between these two. Market price is based on the demand and supply in the market. Different buyers, different sellers, their demand and supply. But when I use my price, that is typically called as a valuation price. Valuation is more of my assessment. What is the true price according to me? See, just like any article we try to buy in the market, there is a market price for it. There is our assessment price to it. We assess the price on some behavior. So that's where for every good, when some people are ready to buy it, some people are not ready to buy it. Even if I ignore their budget factor, right? Probably everyone, let me assume that everyone can afford 50,000 to buy a TV. But still, not everyone will buy that TV. They will have different choices because again they may feel that it is not, this TV is not worth 50,000. But the same analysis done by someone else, they may say this TV is very much worth for 50,000. So market price is the same 50,000, but different people assessing that product on different grounds, they will have a different number. That is what is typically called as a valuation price. How much I value it. What is the value according to me? Value is more of a individual specific, whereas market price is more like a fixed number. So these are market prices for all the premiums. Now I have to see whether this market price is a good enough price or not. Right? Is it overpriced or underpriced in the market? If it is underpriced, I will look at buying it. But if it is overpriced, I will probably look at selling it. Right? If it is overpriced, I would look at selling a call option. If it is underpriced, I will look at buying a call option. Similarly for the put option. Now let's say I want to get into a put option here. You see here for 2,400, if I want to sell Infosys on 28th June, the premium is 6.1. The put premium is only 6.1 because today the price is 2,475. When will someone exercise the put option? Only when the stock price falls below 2,400. Otherwise they will back out. They can sell it in the market for a higher price. So in the next 4-5 days, Monday, Tuesday, Wednesday, Thursday, 4 days, the stock price has to fall by 75 rupees. 2,475 is the latest stock price, the underlying. Here it is not there. In the underlying, this is in the website you are seeing. The Infosys stock price is 2,475 at the expiration. So 4 more days, the stock price has to fall 75 and more. Then only the put will have some value, because I can still sell it at 2,4. Sell the security at 2,4. Because the chances are almost getting slimmer, the premium is getting thinner. If the chances are becoming more and more fancier, the premium will go higher and higher. More demand. See, when I say you will have the option to sell Infosys at 2,6, obviously there will be a lot of demand for it. Right? Today it is only 2,475. I am giving you a guarantee that you can sell Infosys at 2,6. Everyone will demand for it. Now that's where you see the premium for it. The premium for it is 127. Very high premium. In case you are not able to sell it at 2,6, you will lose that entire 127. So determining, because there are so many options available in the market for one single security. In futures, there is no such scenario. Futures, there is only one future contract. I mean, it's only the lot. That same lot and no different prices. Whereas in case of options, you have a bunch of prices at which you can purchase or sell that. And for each one, the premium is different. Now, to which of these is a worth enough one to buy? Right? On Infosys, there are how many? Even if I look at the most actively traded ones, right? These all are not traded. These all are not traded, so there is no last traded price for them. Though the exchange has announced these numbers, no one has really got into the trading for that. So that's where the open interest and everything is blank. No tradings have actually happened. It's only in this range where some trading has occurred. Trading related to options. Only for up from this range only it has occurred. So some people, I mean the open interest wise also, if we see, these are the areas, at least from here, there is a heavy trading. Only for these options, there is a heavy trading from 2,400 till 2,700. In that range, there is a heavy trading. But slightly below that or above this, the trading volume is much lesser, or probably 2,800 is also fine. But beyond that, the trading volume either is nil or very marginal. So people are expecting that the stock price will be only in that range. Now, for each of the scenario, the premium is different. Now I need to have a mechanism to evaluate out of, so there are how many products now? 1, 2, 3, 4, 5, 6, 7, 8 products are there. Different strike prices are, each is a different product. Now out of the 8 products which I have, right, which of them is worth buying? Which of them is worth selling? Right, out of the 8, there are some prices. What can very well happen is, now when we look at our formula and all, what can very well happen is, though the market price for this is 77.6, our formula may say that this value is not 77.6, it's better we go with 75. We may get an answer to our, whatever the formula we will use, we may get the value as, let's say, 75 or 70. So what does that mean? As per our assessment, it is worth only 70. Whereas in the market, it is available at 77.6. So it is available at a higher price than our assessment or than our valuation. So the better scenario is, better go for a selling of it, because it's available at a higher price than what we feel for it. So better sell it. If it is at a lesser price than what we feel for it, better buy for it. So once we create a formula based model, we can very well make out which of these are worth buying, which of these are worth selling, and can I create some kind of a trading strategy on these things. There are a lot of option trading strategies that are available whose target is reduce the risk. Again, though it may require a compromise on the profits, but they will definitely reduce your risk, whatever may be the stock price movement. Right? So we'll just do some kind of basic plottings of the call option and the put option. Right? And based on that, we can very well extend it to the strategies also. And after that, we'll get into the pricing aspect, whether it is overpriced or underpriced. So assuming that this is the chart, initially we'll plot some kind of graphs which will show how the price of these options is typically moving in each of the scenarios, right? And how I can combine 2 or 3 options to create a strategy, and which of these strategies is working well for this security, right? Now let me just look at that stuff. So I'll keep the data as it is.